In the first of these videos we looked at the basic assets and income tests. During this video we'll look at some concessions that are available for farmers. The first one is very important. It's called the Extended Land Use Assets Test. And effectively what this means is that provided you meet the requirements, which includes having lived on the farm for at least 20 years, this test may allow the farming land on which you live to be exempt from the assets test. And very simply, it applies to the title to the land on which your house resides. So if your farm was all on one title, this in fact, as shown in the first diagram, may apply to the whole farm. If your farm comes in more than one title, as shown in the second diagram, it will only apply to the title on which your house is found. There are a number of requirements to be able to be eligible for this concession, but it was extremely important for farmers who are seeking to access the age pension and are stopped from doing so by the value of the farm. It is certainly a worthwhile one talking to Centrelink about. To look at the other concessions available to farmers, we first need to understand what is meant by deprivation of assets, or the gifting rules that Centrelink applies. Basically, any time gifting is looked at by Centrelink, it relates to whenever you have given your assets away or got rid of them for less than market value. You can give assets or gift them up to $10,000 per financial year, or $30,000 averaged over a rolling 5-year period. One of the things to be aware of is that your assets can be disposed of for value other than cash, and this opens up a very significant group of concessions for farmers. The first concession that we need to have a look at is what is called foregone wages, and this is a situation where Centrelink recognises that a close relative might have been working on the farm and has not been paid full value for their labour. This concession cannot apply for any time that the close relative has been in the farming partnership, because they were partners and therefore not entitled to be paid for labour. However, it can apply for any periods after the age of 16 where the person has worked on the farm, including those periods, for instance, if they were away studying. You can pick up the broken periods where they may have been home for holidays or other things to help on the farm. Let's look at an example to show how this works. Let's imagine that Fred and Mary have got a farm worth $1.2 million. Their son is 30 and he has worked there since he left school at the age of 16. Hasn't been paid in that time, just had his board and keep. And Fred and Mary want to transfer the farm to Tom and apply for the pension. At $1.2 million worth of net assets, assuming they have no debt, they would be ineligible for the pension under the assets test. It's easier to get an understanding of foregone wages if we look at an actual example. This is an example for illustration only and doesn't represent the actual figures that Centrelink may use. Firstly, the AWOTI, or the average weekly ordinary time earnings at the time of application for this exemption, is considered. And in this case it was $1,259 per week. An allowance is made for tax that would have been paid on those wages, reducing that to $1,007. A further allowance is made for board that has been provided, and leaving a net foregone wages per week amount of $906.30. You'll remember in our example that Tom had worked on the farm for 14 years, and therefore the total amount of foregone wages in Centrelink's calculation would be approximately $659,000. This value is then deducted from the value of the farm to give the value of farm at transfer, and in this case it is reduced to $540,213. If Tom's parents were to transfer the farm to him, this is the value that Centrelink would consider as the gift. You can see that it falls below the maximum assets limit for the pension, and meaning that the parents would be immediately eligible for at least a part pension. Foregone wages are very powerful if you have a close relative where you have had them working on the farm for less than the full wages. However, they can also deduct other contributions that they may have made, such as contributing to the purchase of machinery or fencing or other improvements. The concept of foregone wages is enabling you to reduce the total net asset value of what you are transferring or gifting to below the assets test limit, allowing you to access at least some of the age pension. The other concession that you need to be aware of is what we call life tenancy or granny flat rights, and these can apply where you're transferring title to the farm but you are going to go on living on the farm, or perhaps the farm is purchasing or providing accommodation elsewhere for you. Centrelink expects that you will remain in that accommodation for at least 5 years, although this may be varied if your needs change, where you need to maybe move into a nursing home or other accommodation. There's no requirement for a formal life tenancy as in a legal agreement. Again, an example, let's imagine that we have Bill and Sue who are looking to retire on the farm and transfer it to their daughter Jill. Centrelink would calculate the value of that life tenancy or granny flat rights as taking the current combined married pension rate and multiplying by a conversion factor which is based on the age of the youngest person of the retiring couple. That value then of $501,000 in this case can be deducted from the value of the house and curtilage that's been transferred, and again helps reduce the value of the assets and may make the older couple eligible for at least some age pension. In conclusion, my advice is always don't self-assess, get information and advice. There are concessions available, and it is really important that you speak to an advisor who is aware of these concessions. I encourage you to contact the Centrelink Financial Information Service. The number is on the screen to get the most up-to-date information.